Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Chipotle Mexican Grill, ticker CMG. Over the next few minutes, I'll discuss my thoughts on both the valuation for this company and its business quality. Now, let's first look at market cap. This is a $36 billion company with a $35 billion enterprise value. That means that they are not leveraged with extra debt compared to their cash on hand. So that's an interesting setup here. If we look at the business description, they own and operate Chipotle Mexican Grill restaurants. These are basically small concept stores of about 3,000 restaurants in the US, Canada, UK, France, Germany, and the rest of Europe. And beta of 1.29, share turnover to 25%. So I've been to Chipotle. It's actually a pretty good restaurant. Like the food there. Fast concept, don't go very regularly. But let's see what the return on invested capital set tells us here. So it looks like maybe this company started up in 1993, and they had some losses in 2002, 2003. I don't know if these were startup expenses. They might be. If so, those would be the only losses, and they have 18 straight years of profitability. That's actually really, really good. Especially if you can consider maybe we pull these off and the next 2 years can be profitable, then you might have 20 straight years of profitability 2 years from now. And that's a nice setup for a very high quality company. The other thing I like to see here is that you have relatively flat stances. It's not cyclical too much. You don't see up and down curves. You basically improved up to 13% return on invested capital by 2005 and maintained a very good numbers since then, with the exception of 2016. So from 2005 to 2008, you had 13% return on invested capital. It rises to 23% by 2010, stays in the mid 20s through 2015, drops down to 1% in 2016, and then back up quickly to the 12% range after that. Now, I believe, without even going too deep into this, that 2016 here, this big drop in revenue you see from 2015 to 2016 was driven by a food scandal that they had. I think there was some sort of foodborne illness that had broken out at some Chipotle restaurants, and that caused a massive disruption in their business. And it looks like they've yet to recover to the product economics they had from 2010 to 2015 because of that. However, these are still pretty good product economics when you see a 12% return on invested capital. So you got to take that into account. That's actually still really good numbers, but it may be that people are relying on them eventually getting back to these higher numbers. When we look at the 10-year median returns, we do see return on equity of 22%, return on invested capital of 12%. All these numbers meet my threshold for what I'd consider a high-quality company. This return on invested capital chart tells me that it would be similar to a high-quality company, especially without that scandal. You wouldn't have this big drop. The big caveat here that I see when I look at these numbers is valuation. This company seems extremely overvalued. We have a PE of 52.7. I don't think I would ever pay a PE of 50 for any company, not even the best companies in the world with the best absolute growth. So I don't think that this sort of PE ratio can be justified. We're going to investigate a little bit to see if that is real. It does look like it, because you have EPS in 2021 of $22 per share, which is the highest it's had in the last decade, and 22 times, about 50 would get you to about this, $1,261 per share. So it's just outstandingly high, and I don't think you can justify a number like that. Basically, let's think about what this through. If they were to double their return on invested capital in 2022, like next year, and you get back up permanently to this 24% return on invested capital range, you would still have a PE ratio of 26 or 27, and that would be assuming earnings go to like $45 per share. That would be both an incredibly impressive performance, and you would still be relatively overvalued at $25, $26 per share. So I think this stock price is probably at least 50% too high, or would require at least a 50% drop to justify interest in this business. But it does appear to be high quality. I mean, you look at this revenue growth, 12%, that's good. EPS 13%, free cash flow 12%. Those are matching up well. I don't like that assets are growing faster than revenue. It does provide an explanation for why you might have lower returns over time, and why it might be hard to get back to the previous level. I would guess that they had to do a lot of investment in order to recover from this scandal in 2015, 2016, and that's what you see with those numbers. It's important to put that caveat here, because the price to book ratio is extremely high at 16.9. It's not like it's just PE ratio. Your return on equity of 22% could justify a price above book, but you're talking PEs of price to books of 2 or 3 or 4, not 16. So on all metrics, the valuation is just way, way too high. Let's see here. Income statement. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. I'm working through every company in the S&P 500, and if you ring that bell, you'll get notifications as I upload new videos each and every week covering companies throughout the S&P 500 and other market caps as well. Now, what I do like is that they have been buying back shares outstanding over time. If I go to thousands here, you can see that this has been declining pretty substantially. They've gone from 31 million to 28 million shares, so they have been buying back shares. That's always a good sign. You see 10 straight years of positive gross profit. Even that bad year in 2016 had positive gross profit, positive operating profit. It's good that even during your bad years, during your scandal years, you're still making a profit. That's what you want to see as an investor. The only thing I don't like is just how much there is a lot of jumping around in these numbers. But again, that 2016 number distorts that heavily. Let's look at our balance sheet. If my guess is right, you're going to see a change in probably the investments since that 2016 scan, and you kind of do see that. You see a big jump here to $4 billion by 2019. You were at $752 million in 2011, kind of growing steadily until 2016, and then 2 years later it jumps up a lot. Now, maybe this is an acquisition. No, it's the inclusion of capital leases, probably. Maybe. Yeah, I think that's what's happening. There was a change in the tax law required a change in or regulation of how you do this GAAP accounting, is that now leases are taken as both an asset and liability, and so you have that change there, and it's going to make the numbers just look worse on a return basis. That actually is even worse for the overvaluation problem, though, because what it means is that these new numbers here are taking into account capital leases that they didn't have to take into account here in this 2010 to 2015 cycle, so you're unlikely to ever reach those numbers again. You're actually probably operating very efficiently at the current ratios. Cash flow. I don't really know why you need a lot of stock-based compensation for a restaurant, but you do have that. Now, you do see net issuance of common stock is higher than the stock-based compensation each and every year. Well, not every year. It wasn't in 2020. Presumably, they paused buybacks then. But you also have to think that a lot of times stock-based compensation, the number put here on cash flow is actually lower than what it should be if you're maxing it out. And so what that does when you go to the income statement is it says this, is you're not seeing a lot of change even though you are doing buybacks. So you've done buybacks every year from 2018 to 2021. These 4 years have buybacks, and yet the number of shares outstanding has actually gone up. And the way that's working is because, let's go back to millions here, is that yes, you have a higher number of buybacks than the stock-based compensation, but usually stock-based compensation numbers might understate the actual cost by 2, 3, 4 times as much. So the true number of dilution here is maybe 300 million, 400 million per year. And so if you're not buying back that much, you're not actually going to lower the price or the number of shares outstanding. So really this number and all of this cash is really just being paid to employees and not to investors. And it's something to be aware of, especially with all this reinvestment being done here. You have a lot of money leaking out of this business. So what you have here with Chipotle looks like a relatively high quality company as much as you can for retail establishment. What's great about retail is that they can grow really well when they roll out across a country. They roll out into new geographies, and you just repeat the concept. And the underlying business is very, very strong. I like what I see here. It's very stable year to year. Doesn't appear to have a problem during recessions. Very strong. However, the valuation is just way too high. You're way overpaying for growth. These growth rates aren't outstanding. They're okay. You're growing at 12% a year. You're not growing at 20%. You're not growing at 30%. You're not growing at 50%. But you're paying as if your 10-year revenue growth rate is going to be 20, 30%, and yet it wasn't. So PE of 52, way too high. This company would be let's go back to the cash flow here. Do they pay dividends? They're not paying dividends. So your only return is this revenue and EPS growth rate. There's nothing else. So for me, I would want to pay a PE of like 15, which means the stock needs to be like 400 per share instead of 1260. So it's just way too overvalued. You can get much cheaper 13% growers. You can find 13% or higher growers at PEs of 10 to 15. You don't need to pay a PE of 15 to grow at 12 to 13% a year. It's just not necessary. You can do it with good returns on capital and everything like that. I own some. They do exist. You might have to look outside of the S&P 500, but they do exist. This is just too high of a price. So for me, good business, bad price, and that's my summary for that. So it won't be going on my watch list because it's just too high for me to even spend the extra time to consider it. Thank you for listening. Please hit that like button. Your likes tell the YouTube algorithm that you're enjoying my content. You would like others to find it as well. Please subscribe if you want those notifications as I upload new videos. You need to ring that bell to get those notifications, and I really appreciate you tuning into my content. Thank you for listening, and until next time, stop paying fees, start building wealth.